Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, we brought on a special guest, Martin Saenz. Martin is the co-founder and managing partner of Bequest Funds, an alternative investment fund. Welcome to the show, Martin.
Thanks for having me on, Marc. Much appreciated.
All right, so I'm excited to talk about today's topic, alternative investments, and specifically investing in notes and mortgages. I think investors nowadays, they're looking for alternative investments for a couple of reasons. You got diversification, some want to build passive income, and then I think some people are just nervous about, where the stock market is, where real estate prices is. So they are looking for alternative ways of investing. Yeah, so let's get started. Maybe you can give us, a quick background on what is note investing and how'd you get into it?
In 2003, I was fired from a corporate job because it just wasn't a fit for me personality-wise. And my wife and I determined that I needed to do something for myself, be in the business for myself. So we started a government contracting company. And through the course of time, we accumulated a number of commercial and residential properties as a buy and hold play. So we were landlording for a while. Mm-hmm. What we realized in 2012 is that, operating a small business, landlording all took a lot of time and attention and effort. And we wanted something to build more freedom of time in our lives. And so we sold the company. We still manage the properties. And I got into the mortgage note industry. What that means for myself, because there's a number of ways you can go into note investing, is if you take an individual that's looking to purchase a home and they go into a bank, complete a mortgage application and get approved, and they receive a mortgage and a note to purchase a property. The note being a promise to pay back money given a certain set of terms, and then a mortgage ties that promise to the property in the form of collateral. Well, over the period of time, 4% of those mortgages go into default. So something happens in the borrower's life, they get divorced, they lose their job, they have a health issue. I mean, things that everyone here probably can relate to in some regard. And so the borrower stops paying, and then the bank bundles those defaulted mortgages into a tranche and sells them into the secondary mortgage market to a hedge fund at like 20, 30 cents on the dollar. Well, that hedge fund goes and works with the borrower, because now the borrower has their job back, they remarried, they got their health back, and the borrower starts making payments again. And over the course of time, those mortgages become re-seasoned. And so from that point, Bequest Funds purchases them into our fund at 70, 80 cents on the dollar, which equates to about a 12, 13% yield. And in return, with the investors that have come on board, we pay our investors a 9% annual preferred return, and we make our payments monthly. So the model is pretty simple. We receive borrower payments in monthly, and we pay our investors out monthly. Really, the secret sauce to all of this is that the mortgages held in our portfolio are all owner-occupied properties. So these are people that have emotional equity. They're residential properties. These are people's homes they're raising their families in. And so there's emotional connection that way, while the portfolio itself sits at a 62% investment to value. So there's equity cushion backing the mortgages that are in there.
Yeah, perfect. Great intro to it. I have a couple questions from it. So first question is, what determines when a mortgage goes into default? Is that something the bank determines? Is it they miss one payment, they miss 6 months, a year? What is there a standard default, or is it kind of when the bank says it's defaulted?
Yeah, so generally default takes place when the borrower's beyond 120 days past due. The bank's going to hold it on their books for a few years before they consider bundling it in a tranche and selling it to the secondary mortgage market space. And they're doing that for a number of internal reasons, also including that, it's falling outside the securitization parameters that they have set in place. So it's no longer a securitized mortgage. So there's a number of factors in play why a bank, wants to bundle it and sell it off.
So then the bank bundles it up, the hedge fund comes in, the hedge fund can't pick and choose, right? It's the tranche, they either take it or leave it, and then they deal with whatever's inside that bundle?
That's correct, yes. Yeah, so they're buying an all or nothing at that point from the bank.
Then the hedge fund works and tries to get these loans back to performing loans and back on track. And then do they do the same thing? Do they bundle up a subset of them, or just other, do they take some from this tranche, some from this tranche, and they bundle it up, and then it's kind of the same thing on your side where you're coming in and saying, okay, we'll take this tranche here?
Yeah, so when I first came into the space, I launched a hedge fund. I actually have two different operations. One is the hedge fund that works out these non-performing loans and gets them to perform. And the other side is Bequest Funds, which is houses performing mortgages purchased in the secondary mortgage market space. And it's more of a longevity annuity play. So I understand it well from both sides of the fence. But some hedge funds, their objective is just to buy 2x their money and sell off smaller pools downstream to more retail buyers. For my company, it's always been a longevity play. We're cash flow investors. So what we want is the monthly income from the borrower's payments. Right. So we want to keep it through the duration of the term, 20, 30 years, whatever.
So you're actually servicing the loans as well after Bequest acquires them?
So we have a licensed servicer that we use as third-party licensed servicer. However, we piggyback off of the servicer. If there's any need for communication with the borrower, we'll piggyback off the servicing effort. So we have a licensed servicer in place that collects payments and issues out loan account statements and year-end tax forms. But we also have an internal asset management team that monitors the performance of the notes in both the non-performing state and the performing state.
Yeah, makes sense. I think if you look at it from the investor's eyes, that they're always looking at risk. And what happens if the loan you acquire goes back into that default state? Is it something that you try and work back to getting performing, or do you at some point package it up and send it back to the hedge fund?
Yeah, so there's about 160 mortgages that reside in Bequest currently. And the pool itself sits at a 90% collectability percentage. So it's a very healthy pool because we're buying them in after they're seasoned and they meet the underwriting criteria. But with that said, we've never foreclosed on a loan within Bequest. Really, when a borrower stops paying, whether they're on the hedge fund side or on the Bequest fund side, that's our area of expertise. So we have a number of different ways that we connect with the homeowner. We have, legal means if we need to, and we also piggyback off of servicing efforts. So we monitor the performance of these performing mortgages on a daily basis. It's part of the KPIs that everyone's required for within the company. So we're on it. If someone's slightly behind, we're picking up the phone and reaching out.
Do interest rates have any impact on the loans in terms of not necessarily the loans, actually the performance of the fund? Or does it not matter because it's really what the hedge fund's able to buy it at, what they're able to sell it at, and then what you're able to acquire it at? Is that more along the lines of how the returns are generated?
Yeah, so the annual preferred return is 9%. So we're buying these mortgages in at a 12 to 13% yield. So that's all fixed, as you're kind of suggesting. Where inflation may come into play is it affects the US dollar. There's a lot of money in circulation currently. Duh, right? Everybody knows inflation's here. So at some point, you might have individuals that are looking for riskier investments so they can meet their yield criteria. Or, if inflation got to the point where it exceeded 5%, on up to 9%, then that obviously puts the fund in jeopardy because we're locked in with what we purchase the loans at, and we're locked in with what we pay out the investors monthly. But I think by the time that would happen, the stock market and, a lot would be negatively affecting our economy.
How's the fund structured? Is it like a rolling fund where you're accepting investors at any time, or do you have specific raises and you close maybe of sub funds, or you close one fund and then open up another one?
Yeah, so it's an evergreen fund. And this particular, the income fund launched in February of last year. So there's only $7 million assets under management. It's capped out at $50 million. So we have about $43 million to go. There's no expiration date. So that's the whole, hence the name Bequest. It's a legacy play that it's something that myself, my partner, and the investors are looking to pass down to future generations as a source for additional streams of income. So really, we're kind of long-term players in terms of how it looks. When we cap out at 50 million, which we anticipate doing in about 2 to 3 years, then we'll launch an additional fund from that point.
How has last year, with all the craziness going on? I mean, and I know the fund is relatively new, but did you see any, like, a lot of variability in people paying, not paying their mortgages?
Yeah, so when COVID first hit, I mean, we have another side of the business. There's about $35 million at work there on the hedge fund side, and we've been doing this 9 years. So we've seen kind of the trends in the marketplace. But when COVID came, our thought is we would be seeing our collectability percentage go down to 75%. 90% is the industry standard. If you're thinking about, the investment to value at 62%, we can absorb some deficiencies. We can absorb some collectability issues and still be okay. So 90% is the threshold. We never want to go below that. But we were thinking about 75%. So we actually converted some of the processes. We were looking at our performing mortgages, collectability percentages, delinquency buckets, and everything on a weekly basis. We converted that to daily. So we get more of a real-time feel. And what we found is two things. Collectability ranged from 92 to 93% all year throughout COVID. It's sitting at 96% now. So we found that out, which was a pleasant surprise. But we also found out that a lot of what was in the media was not reflective of what we were seeing. People were actually valuing their homes more so, fixing them up. They're there staring at their homes and their walls much more than they were in the past. So there was more of an appreciation for where they lived. And as a result, we were receiving payments accordingly.
Makes sense. And does the homeowner have the ability to refinance the loan if they wanted to?
We're seeing unprecedented times with payoffs in our industry, which is really good for investors in that if we have loans in the fund in Bequest, and about every month we're getting a payoff on a mortgage. And so how that helps the fund is we're able to receive capital gains. We're able to go out and buy additional mortgages, which creates further padding for investors in the fund. But all across the industry, hedge funds and people that operate in the mortgage industry are receiving payoffs at never before seen levels based on the interest rates that are out there in the marketplace and people just refinancing.
Mm-hmm. And I know you mentioned you have a preferred return, 9%. What happens on either side of that? What happens if something changes in the market and no longer can you purchase these for 80 cents, you have to purchase them for 90 cents and then the reverse. What happens if you can purchase them for 50 cents on the dollars? Because I guess, you know what you can purchase them for now and you know how to build that into the 9%, but what happens if things change?
So right now is actually in the mortgage note side, it's actually inverse relationship. So it's actually, we're seeing our recessions now, actually, when there's a housing boom. So actually, we're seeing limited supply of opportunity, of inventory, and prices are really high. So when the market turns, and it will turn at some point, there's going to be an increase in inventory and a decrease in pricing. So we normally would be buying these mortgages for 13, 15 cents on the dollar. Or I'm sorry, 13, 15% yield. So we're paying a little bit more right now. But this is where we also have an 8% annual preferred option with only a 1-year lock-in. If someone's concerned with inflation, they can come in at 8% and only lock in one year and be able to kind of adjust from there.
One of the questions I always get with a fund like this is, how long am I locking into? What's the normal lock-in period that someone has when they invest in the fund?
One option we have is 8%. That's a 1-year lock. And then the other option is 9% at a 4-year lock-in. Half of our funds come from self-directed IRA funds. So generally, those people opt into the 9% option. and they want,
Longer-term.
because they're not going, yes, longer term play. But, there's people that are using, real-time funds, and then they just want to come in for a year and kind of test the waters. But at the end of the day, I mean, I think whether someone comes into Bequest or someone goes to some other solution, I think everyone in general in the marketplace should be thinking about inflation and adding additional flows of income into their existence on a monthly basis to be able to absorb the hits they were about to face, because they're coming. It's just starting. This should be someone's world. So I would say, like, I hear everything because we talk to new investors all the time. And sometimes we talk to people and they're like, well, I got a few $100,000. I don't know if I'm going to put in precious metals, cryptocurrency, Bequest Funds or whatever. And it's just, we always want to understand, what their objective is. But for me, my mindset's always made up. I'm about more passive income monthly coming into my existence because I know what's coming in front of me, and cryptocurrency is not going to feed my family.
Right.
Precious metals is not going to buy groceries at the grocery store. So I need hard cash coming in monthly, and that's my only kind of thought on it.
Does it work similar to a mutual fund? For example, if someone didn't want to take the distributions each month and they wanted to reinvest them, is there the way to just say, okay, just buy more shares of the fund with the instead of, have taken distributions from it? Yeah.
So the fund compounds at the 9% option, it compounds at, I think, at like 9.38%, something like that, roughly. The 8% compounds at 8.29%. Some people just let it ride. I mean, especially IRA investors, they're just going to let it roll over. They don't need the income coming into their fund on a monthly basis. So they're just going to let it compound at 9.38%. But yeah, either way works for us.
What criteria do you use when you're picking what mortgages or what notes should be in the fund? I know you mentioned owner occupied, but what else goes into determining, yes, this is a set we want, or this is no, we're going to pass on this one?
Our average fair market value of a mortgage that's in our fund is $311,000. So we like to see a quality asset that's the collateral for this mortgage. So if there's default, we need to be able to foreclose on the property if worst case scenario occurs. Our average loan, because we do have a combination of senior liens and junior liens in there as well. But collectively, it always has to be, we're looking to hit below that 65% investment to value ratio. So that's key. If we're exceeding that 65% investment to value, so let me just kind of explain it for some folks that may be like, what the heck's he talking about? So if you have a home that's worth $200,000, we're not looking to be into that investment more than $130,000. There may be $180,000 owed that we're purchasing in terms of principal balance, but we're not going to look to pay more than $130,000. So it has to meet that metric. We're looking for houses in suburban, tertiary markets with HOAs and whatnot. So we try to stay away from blighted properties and so good quality products. We also do underwriting on the borrower and their ability to pay. So we do credit checks, skip tracing. So we want to make sure that the borrower is making payments to the other liens on the property as well as just other people in general. So credit scores we're looking at. So we're looking both at the property and the borrower and their ability to pay.
You have that info. You can go and look up do some sort of underwriting on the borrower to make sure they fit some kind of criteria that you're looking for.
100%. So in addition to that, we're looking at servicing comments from where we're buying it from. We're looking at pay histories. So we're just making sure that the seasoning actually occurred as they said it was to occur. We're looking at everything as a bank would look at these loans upon origination. We're doing the same type of exercise.
And you mentioned it a little bit, but do you look at geographical location to select, or is it less of a criteria that you look at?
We're looking more importantly at the property itself and the borrower and their ability to pay. We're in 34 states. We consider it spreading the risk, so to speak.
Mm-hmm. And what access to what's going on does the investor have? Do they see, like a statement that just shows, all right, this is how much I put in, this is how much it's worth, or how much is coming back? Or do they have any insight into what's going on?
So we did a survey before we launched the fund about what people hate about about alternative investments, and that was like the number one thing. You would think, return, someone making the most on their return, but if you're making 12-13% and the fund operator is dark on you and you don't know what's going on, I mean, that will drive you nuts as an investor. But if someone's making, 9% and then we're over communicating, that's what they're looking for. And that's what we found with the survey. So what we did is we hired a third-party fund administrator called Sadrania. And what they do is they take care of the administrative portion of running the fund. They operate our portal. So investors get to go in and see where their investment's at on a 24/7 level. They're able to pull down statements, which are sent to them monthly. We send out weekly educational articles in email. We send out a quarterly statement with financials for the fund, as well as we're signed up as a gold standard with a company called Verivest, which is a third-party fund oversight company that does background checks on my partner and myself, monitors our financials, monitors our operations and our portfolio on an ongoing basis. So it's like an ongoing audit that's taking place with the fund. So we over communicate. We leave the oversight to third-party organizations, that are good with that. So my partner and I can focus on two things: acquiring assets and managing the performance of the assets. And that's how we're set up.
And I think I agree with the survey results, because that's what I've seen from investors. And it's just from the perspective, they get nervous when they think it's a black box. Their money's going in, they have no idea what's happening. Even if they're not going to evaluate and analyze the actual underlying mortgages, just having the ability to see it in there, I think, goes a long way for their comfort, in investing. So I do agree.
It's interesting with, let me grab this here. So this phone here, and I talk to prospective investors. I talk to our current investors daily. What I find is I say, where are you at currently with your investments? Oh, the stock market. I'm in these stocks and this is mutual funds. And I go, how often do you look at your phone per day to see what your investments are doing? I normally get that they look at their investment performance throughout the day, each day. That's the typical answer I get. And so what I say is, I'm going to prescribe you something. I'm not a doctor, but I'm going to prescribe you peace of mind. Something like Bequest Funds or an income fund can make it be where you place one simple investment and you receive cash flow monthly for the rest of your life, passively. You don't have to be buggy on your phone. You don't have to be kind of wondering and worried and nervous, and give yourself the gift of less stress in your life. And that's kind of what we like to do with Bequest.
Does the investor have the option to turn on or off the actual passive income coming to them, in terms of maybe they start off and they say, I just want to compound this. I just want to reinvest this. And then at some point they say, you know what, I think I actually could use that passive income coming in.
Yes, they can turn it on. They can switch back and forth between compounding and monthly distributions as they wish. They just have to notify the fund administrator, and then they'll flip the switch.
And is that profile of the type of mortgage or the type of loan that you're looking to add to the fund, is that owner-occupied $300,000, whatever, around that? Or do you also include other types in there, like maybe commercial or properties that are investment properties? Or do you really stick to that owner-occupied?
We built the fund on three pillars, the first being the owner-occupied residential mortgage. And then we built another pillar for hard money lending on note pools, as well as rehabbing properties. And we also built it on business notes. So this is where a business was sold, a note was taken back, there's probably real estate involved, and we would consider that from a cash flow play. Now, we built those second two pillars in case we realized a slowdown on the purchasing with performing mortgages, residential mortgages. So if we had a pile of cash sitting in the bank and no opportunities at hand, we wanted to give ourselves a plan B or plan C to go be able to deploy the capital. But to date, we've just been, seen opportunity after opportunity. We've had no slowdown in terms of purchasing these performing residential mortgages.
And I know you mentioned earlier about there's a mix between senior loans, junior loans. How do you manage sort of like the overall risk in the fund?
Yeah, so it's actually an interesting question because most people would think that a junior lien is riskier than a senior lien. However, there's a lot of justification to that we could discuss whereby I would argue that the senior lien is riskier. Oftentimes, the banks are not selling off high dollar fair market value senior lien non-performing loans into the marketplace. They're selling off junk properties, properties that are 50K, 70K, even 20K fair market value. The senior liens that are performing in the marketplace tend to have a significantly lower fair market value associated to them. So the collateral backing the loan is not as strong, as well as the borrower that is residing in that home, like a 50K home, is not going to have the resources and the means to maintain payments over the course of the loan as much as someone in a 500K property. On average. I know, it's just a rule of thumb. So we see a better class of borrower, a better class of property on the junior lien side. But either way, we're open to buying both.
And how does it, I guess, just going back to the bank, I'm trying to look at, I get how where everyone's coming from in terms of how they're trying to utilize this. And you sort of just touched on it a little bit. How do they decide to basically give up on if they're selling it for, let's say, 20 cents or 30 cents, how do they decide that, okay, this is, do they have some criteria they use to say it's not going to, this isn't going to work for us, or we're not in the business of trying to get this loan back performing? How do they process it on their side?
I would say that's above my pay grade to understand, how the internal workings. Right. I would just say that a lot of them, they may charge off the loans internally in the bank too, so they have like some tax advantage to doing that. I think that it also deals with how the loans are securitized. If they're defaulted over a certain period of time, it kicks it out of securitized status, so that affects the bank in terms of the number of reserves that they have to hold on their books while they're lending out. So defaulted paper negatively affects what they have to hold for reserves. It could be just, if it's a smaller bank, it could be that the credit officer, the person in charge of lending, it's a negative for him or her to have it on their books. So they need to get it off their books as fast as possible, even though they're selling it for a discount. There could be a number of reasons.
Okay. Going through some of the videos on your site and your website, it talks a lot about no fees. That's one of the questions that always comes up and starting to get more attention just in general. Everything from me to funds to everything, the spotlight's on it a lot. So maybe you can talk a little bit about that, and then maybe also explain what a preferred return means.
Yeah, absolutely. So no fees is very significant for us because when we put this together, we heard from a lot of investors that they were getting feed to death, upfront fees, backdoor fees. I mean, fees fee for everything. We said we wanted to offer the annual return, either it's 8% or 9%, whereby there's no fees associated to 8 or 9%. All necessary expenses, all money required to operate the fund is going to be on top of what we're assuring that we're paying to our investors. We take a very simplistic approach. So if I say, hey, Mark, congratulations, welcome to Bequest Funds, you're going to receive 9% on your 100,000. So that means that's 9% earned, 9,000 earned over the course of 12 months divided by 12. That's your monthly payment. You can do the math on that. So it's very simple, and there's not going to be any fees associated. Now, annual preferred return, there's currently no leverage in the fund. So what that means is, as an equity stakeholder invested in the fund, you're first in line to receive payment. So before anything's paid, expenses, before I'm paid, my partner, any bank or what have you, you're paid first. So that gives you assurance that, the money's headed your way.
Okay, great. So we're just about out of time. Martin, I'd like to thank you for being on the show. You provided a lot of great information. How best can someone get in touch with you, find out more information about the fund?
You can email me at info@bqfunds.com, and we'll send you out a free ebook, or you can visit our business page on LinkedIn at Bequest Funds if you look that up on LinkedIn.
Great. And we'll link to all that in the show notes. And thank you everyone for tuning in to today's episode.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.